The first company that we're going to look at is Thornton's. As we can see here, there was a bid in for the company from Ferrero on Monday. The offer was 145. That was pretty far above where the shares were trading. I mean, for me it was unbelievable considering the difficulties that the company has had. If we jump back to the last trading update, we can see that Thornton's was having quite a significant amount of trouble with this FMCG strategy. This was a strategy that I thought was a good idea earlier on this year, but the way it worked out was that it was just pushing too much stock into the grocers. They weren't able to sell it. The blowback was that a lot of them decided not to order again. It was also interesting. This was something that you really had to dig into the financials for, was that the company was losing quite a lot of share in the inlaid box chocolate market. The company hadn't reported on this for the first half of the year, so it was looking like they were going to need to confess to this sometime soon. My view here is that if this didn't happen, there would need to be some kind of strategy change, possibly a CEO change, that would have seen the company move back towards the retail division. I think that's why Ferrero probably were interested. I mean, they're the perfect strategic buyer. And finally, it's worth just pointing out that Crystal Amber was a big shareholder here, so we can assume that as soon as things started to turn bad, they jumped in and tried to sell the company. I think that's quite interesting because it's something that I didn't really think of when I was looking at this company. There obviously seems to be quite a lot of value in having a big shareholder like Crystal Amber who is going to be active and try to realize as much value as they can, however they can. I think this is the end of quite an interesting story here. It would have been nice to see how this actually works out, but this is where it ends. The next company that we're going to look at is Telecom Plus. They reported final results on Tuesday, and this is a situation that we've been following quite closely. First thing to note, if we just jump over to the price history, we can see that the market has responded quite favorably to these results, so bear this in mind when considering this discussion of the results. Looking at the headlines, revenue up 10%, adjusted PBT up 22%, so we've got a bit of operating leverage. All the customer numbers and the service numbers appear to be going quite well. The company sounded a more cautious note going forward. The reason for this is essentially this paragraph here. Wholesale energy costs have fallen quite significantly, but standard variable tariffs haven't, and we should bear in mind that Telecom Plus's supply is benchmarked against the standard variable tariffs for the Big Six, and what the Big Six have done is, rather than lower standard variable tariffs in response to the drop in wholesale prices, they've been using this surplus to fund introductory deals. And the company has also seen competition from a number of new entrants without the burden of hedging at the higher wholesale cost. Now, the company said that they expected growth to remain in mid-single digits while this gap was present. This is actually a guide down from what they reported a few months ago at the trading update. 40,000 to 60,000 customers, growth over the next 12 months. That is about 6 to 10%. The company has obviously got significantly more cautious in their outlook, which of course makes it strange that the shares rallied so much in response to what was essentially the company guiding down. If we jump back up to the final results where they're discussing the issue with the wholesale prices and whatnot, they say that there is a widespread expectation that this issue will be resolved through a combination of regulatory intervention and reductions in SVTs. It looks like SVTs are going to be reduced. That means lower wholesale prices and a more competitive price for Telecom Plus's customers. However, I think that investors really need to scrutinize the news coming out of Ofgem and the CMA's initial indications document on their investigation into the energy industry. Basically, I think it seems pretty clear that Telecom Plus is saying regulators are going to intervene. They do say that the SVT, there's some sort of uncompetitive behaviour going on there. It's perfectly evident from the fact that prices haven't been lowered. But Ofgem, and this is just one example, seems to be saying not that SVTs need to be lowered and that market needs to be made more efficient, but that customers need to become slightly more aware of those fixed price deals. And we see this in Ofgem really encouraging price comparison websites to become more transparent, more consumer friendly. I think people should just look into this themselves, come to their own conclusions about it. But I would say that there's definitely something interesting going on here. The final point that I think investors need to look at is exactly how adjusted basic earnings per share is calculated. Somewhat unusually, the market is taking this number as read. Analysts are using this in their projection of forward earnings. When this happens, it's pretty much always an extremely bad sign that something is wrong. And I just think people need to scrutinize how this earnings per share number has been reached. I mean, because there is just a massive difference from basic earnings per share. In my view, basic earnings per share does reflect the actual earning power of this company. And the difference is about 5 turns on the PE multiple. So this is a pretty serious issue. So as you can tell, I'm not exactly bullish on this company, but the market has gone up and I've been wrong. So there you go. On Monday, Ladbrokes announced a potential merger with Coral Group. I think this deal looks quite interesting to me. I'm not totally sure that it will happen. I think there's a lot of negotiations still to happen. There's competition concerns. But I think this clearly demonstrates the direction that this industry is heading. Everything's consolidating. They're consolidating online due to POC. They're consolidating retail due to the decline in volumes. And it looks to me like this is a very exciting industry to invest in with a huge amount of potential. I mean, the thing is that right now it doesn't look good because you've got these businesses that have one area that is working quite well and another area that isn't. Whenever you come across these situations, I think it's quite likely that if you just look a lot further down the line, it becomes more clear how management can create a lot of value for shareholders as the growing parts of the business start to become more apparent. I think this deal would create quite a lot of options for Ladbrokes going forward. The retail business would certainly be at a scale that makes it far more economic. I saw the cost savings projections is something like 70 million. I'm not quite sure if it will work out like that. I mean, there's been a lot of cost cutting already, but this really is a very interesting deal. The market responded obviously very favourably to even the notion of this deal. So I would say that investors need to have a closer look at this company. The other point to really emphasize with this is that this is just one release in a series of releases that the new CEO has made totally clear that things are going to change. He's really going to try and turn around this business. We saw the examinership of the Irish business, new chairman. We actually saw this a few days after the company said that it was completely going to restructure the international operations. For Ladbrokes, this is extremely important because a lot of the stuff in Europe has just been totally rubbish, so there definitely needs to be some changes here. So the rise in the share price seems to be a bit of an overreaction, but we should bear in mind that there is a lot of other stuff going on here. The shares were rising pretty strongly into the business review, and this decision has obviously made quite a few people go, okay, we'll just buy it now ahead of the business review. So I think this is a very interesting situation to keep an eye on. The next piece of news that we're going to look at is Trinity Mirror's trading update that they released on Friday. The key numbers here: revenue down 11% year on year, publishing down 9%, print declining 11%, and print advertising down 19%. Circulation revenue was actually down 6%, despite an increase in the cover price, so volume here must have been absolutely terrible. And the company is now targeting 20 million of savings, which is doubling from the 10 million that they announced earlier on this year. We've also got phone hacking. I don't want to go into this in too much detail, but it's worth pointing out that the Mirror actually seems to have had a far bigger problem with this, but it's just taken quite a long time to get around to this actual case, so I don't think this is going to resolve well, but you can come to your own conclusions on that. If we look at the annual results for 2014, we can see that the trends reported on Friday show an acceleration of revenue declines, circulation down more, advertising down more, obviously print down more. What's also interesting to note is that the costs, that 20 million just doesn't seem to be anywhere near enough to make up for these revenue declines. Revenue's obviously come down quite a bit already in the past few years, but this trend doesn't appear to be showing any signs of slowing. It's actually accelerating, and it's probably going to be quite difficult to actually cut costs in line with it. Probably impossible, actually. I think the question here is whether there's actually a sustainable business here, whether the print business declines and levels off. The point from this results is that the digital business just wasn't large enough to produce an amount of revenue to offset the decline in print. And so the question really is whether the print business is actually going to settle at a level and just stay constant or slowly decline. In that case, there probably is a business here that can survive in the long term. There just appears to be no evidence that the decline is slowing down. It's clearly accelerating. So there doesn't appear to be a sustainable business here at all. The interesting point to note, though, is that there are a few other companies experiencing these kinds of trends. So it's kind of interesting to read across and think about perhaps why Trinity Mirror is suffering so much, and how other companies could be better placed or even worse placed than Trinity Mirror. I think the trends that we see in Trinity Mirror are definitely going to create a few opportunities in the coming years. So it's worth keeping an eye on this one to see exactly how it plays out. Next company we're going to take a look at is TSCO. They released their trading update on Friday. Obviously much anticipated, and the sales performance pretty good. Like-for-like sales improved to negative 1.3%. Like-for-like volumes up 1.4%, transactions up 1.3%. So obviously prices were down quite a bit. If we jump down to the historical like-for-like sales performance table, we can see that TSCO appears to have pulled things around in the last quarter of last year. It had really terrible like-for-like numbers through most of the last financial year, but does appear to have pulled things around. It's worth pointing out that these numbers put TSCO ahead of Sainsbury's, which have started to see slightly worse like-for-likes, and ahead of Morrison's, which has just continued to underperform. If we dig into these results a bit more, we can see that deflation is continuing. That's kind of unsurprising, and the company made these significant price cuts in January on branded products. It's just worth pointing out that we did see some improvement around this time, so it's not clear exactly why the performance has improved. Maybe it's just the business settling at this lower level. Maybe it is something that management have been doing. I'm not really too sure. The main implication from this set of results, though, is that the turmoil is clearly continuing in this sector. It's probably bottomed, but it isn't clear that it's going to settle at any rate that is favourable for these companies. I think there's quite a large read across from these results to some other listed companies that are even less well placed to cope with supermarkets becoming a lot more competitive on price. The next company that we're going to look at is DNLM Group. on Friday. They reported that they had found a new CEO. This is a process that has been going on for about half a year. The company had quite a poor run in 2014, and essentially Will Adderley, who is the executive deputy chairman, decided to get rid of the CEO at that time. Will was previously the CEO for DNLM Group between 1996 and 2011, and he took over the CEO role after getting rid of the last one. And today the company announced that they had found a new, hopefully long-term CEO. What's quite interesting is this 6-month induction period. I don't think you're going to find that at many other companies. I don't think you'll find a lot of CEOs willing to sort of put up with this. But I think investors are going to quite like this. I mean, the performance of the company improved very significantly when Adderley came back into the top job. And Brad seems like he has solid experience. So I think this is change to take note of. It's definitely a positive. The final company that we're going to look at is Greco. Greco's been having quite a difficult time of late. It lost its CEO Rupert Soames to TSCO, and I don't think growth in the company's core power projects business has been particularly impressive either, especially as this once was considered a very high quality business in an industry with basically no serious competitors. Today the company announced some organizational changes ahead of the completion of a business review by the new CEO Chris Weston in August. I'm quite interested to see how this strategic review comes out. The decision that was reported today was to split the business into Greco Rental Solutions and Greco Power Solutions. The previous split was between local business and power projects. Local business consisted of small temporary power projects and basically all the other local business stuff like temperature control. And the power projects unit consisted of all the remaining large power projects. I think what this split reflected was that the main difference between all the company's products was who was buying it. The power projects was mainly dealing with large government-run utilities and the like. The local business was largely comprised of small local offices dealing with local businesses. The new split is that Greco Rental Solutions will essentially comprise all of the local business developed markets stuff, and Greco Power Solutions will comprise the power projects business and all the local business units in developing markets. So the move is pretty much from a customer-based split to a geographic one. I don't quite see the logic in this because the local business units and the power projects units were clearly very different. They were selling to different customers, so it's difficult to understand why there should be some kind of geographic synergy between the local business and developing markets and the power projects. Yes, the main customers for the power projects business were developed market countries with poor power infrastructures and the like, but it just isn't clear to me that there's as much synergy as under the old structure. Now what this could suggest is that the company is going to start de-emphasizing the power projects business. Perhaps local business salesmen will move into the power projects unit, I don't know. It just seems like this first move isn't particularly clear. The final point worth noting is that the company has quickly appointed someone to lead the rental solutions business, but hasn't found someone to lead the power solutions business. CEO Chris Weston is taking over for the intermediate time, but it does seem like the emphasis of this business probably is changing, and in a way that most investors probably aren't going to like very much.